Right. Good afternoon, everyone. Yeah, we're finally reached the last session of the day, and also very looking forward to having this discussion with Percy. Um, yeah, so Percy, for those who don't know, Percy Hung is an entrepreneur and investor based in Singapore. He is the co-founder and CEO of Choco Up, one of Asia Pacific's largest revenue-based financing and growth platforms that offers fast-track data-driven funding to fast-growing companies that require rapid capital deployment. Percy leads the sales, marketing, and business strategy at Choco Up, aspiring also to bring this up innovative funding solution to the rest of Asia Pacific. Percy is an alumnus of Georgia Institute of Technology, where he studied aerospace engineering. He spent his early career as a product engineer at multinationals, including Asbil Corp in Tokyo, and focusing on operational efficiencies and performance capabilities. Always curious and fascinated by the fast-changing and innovative world, Percy later pursued a startup adventure in online sportswear customization, a decision that kickstarted his entrepreneurship journey. He then later co-founded Healthy Chicken, one of Hong Kong's earliest health concepts restaurants. So Percy firmly believes in the power of technology to disrupt the outdated, complex, and rigid financial system. So he wants to make funding simple, transparent, and truly growth-centric. So under his leadership and mission, Choco Up's team is dedicated to making obtaining funding a quick, efficient, and founder-friendly process. So Percy, I'll hand the time over to you now, as I believe you've got a short presentation for us.
All right. Thank you, Paul, for today's time.
No
And
worries.
it's nice to meet everybody here. Let me share a very short deck. All right. Oops, sorry. All right, can everybody see this? Cool. All right, thank you. So today's topic, it's about navigating today's market and with alternative financing. There are a lot of different type of alternative financing out there in the market. You can use different type depending on the needs. So a lot of people ask, hey, what is alternative financing? So basically anything other than a bank loan, you can consider that alternative financing. So my story, like what Paul has said just now, we started Choco Up because myself, our founding team, our co-founder, and our first couple members on Choco Up, we all had business experience prior to join Choco Up. We had online stores, we had brick and mortar shops, we had platforms, we had marketplaces. So all of our stories come together and we found one common pain point as a business owner. It was really hard to borrow money. So how does money come? Like there are a couple ways. You use your own savings. You reach out to your friends and family or fools. You go to a VC or family office, private equity, but those needs a lot more tech or proprietary information and ideas. It's not just like, hey, I want to open a cafe and then I can get some funding from a VC or a PE, right? And or you can go on to the alternative route. There are such as venture debt. Venture debt is another form of alternative financing, which can come in handy depending on your needs. There are other fintech companies like funding societies that could really solve your problem as well. So there are a lot of these products out there. But we started because what me and my team were doing before, we couldn't get easy access to money for whatever we were doing. And hence we started doing research and we chanced upon RBF, revenue-based financing. So in short, RBF is similar to debt, but we behave like an equity investor without taking a single percentage of your share in your company. So we give you X amount of dollar. We help you to grow. We teach you how to grow because we realize a lot of lenders, so-called, or private credit, when they give you money, they don't care about you. That's not how to grow. Our mission, besides providing the ease of access of capital to you, we want to help you to grow too. So there are two parts to what we do: give you the funding and also help you to grow. So that's how we started, because the bunch of us really needed some money 5-6 years ago. Here's a very short video of how revenue-based financing work. All right, cool. I'll sum it up. I'll give an example of how does the RBF model works. So if your business needs $100,000, we'll give you $100,000 upfront. We don't charge an interest, we charge a flat fee, say 8% or 10%. Sorry, that's a Q&A. Can we get the sound on? Oh,
no. Don't worry, just go on and finish it. It's fine. We'll add some more time.
All right.
Yep.
Sorry. Okay. So we don't charge an interest. It's a flat fee that we charge. And how do you repay us? It's based on your sales. So for example, the first month, your sales is doing pretty well. We take a percentage to fill up that $108,000 that we give it to you, plus the fee, right? So you fill this up as you do your business. So for example, Chinese New Year in February, everybody take a break. You have no revenue for that month. So you don't pay us back because you have no revenue. Hence the name revenue-based financing. So we want you to do well so that you can pay us back faster. And business is very unpredictable. A traditional bank or traditional lender perspective, they don't care whether your business do well or not. They will ask you to repay the principal plus interest every month. But for the RBF model, it doesn't work that way. If you do well, you pay us back a bit more. If you don't do well, or if you have a low season or low month, you pay us less or you don't pay us back. So the interest is aligned that we want you to do well. So we give you the money, and then we have analytic tools to help you diagnose your business and help you to grow as well, which I'll talk a little more in a bit. So let me move to, oh, sorry. Okay. We have some case studies. So essentially what did they use us for? There's a couple of main purpose. Digital ads, Google ad, Facebook ad, because every business owner, your cash pool is only this much. You have to allocate certain amount for inventory, certain amount for OPEX, certain amount for digital ad spend, certain amount for rainy day. So you can only pick and choose how to use it. But because we can analyze your sales data, we can project how much you're going to make based on your ROAS. And so we can give you a credit based on that. And hence, the money can come into your account within days, couple days max, leveraging on your data. So this is cheap. They used to be called Butter. They've been acquired by Love Bonito. So they started during COVID, and cash flow is pretty tight for them. However, they're gaining popularity. They needed a bit more colorways and SKUs, and to do a bit more ads. So we came in, we look at their financials through the data because they're selling on Shopify. They plug into our backend, so we pull the data right away. We can predict and project how much sales they're gonna make, given using our algo, and we feel comfortable, and then we funded them pretty much immediately within a couple of days. So this is how we fund our clients. So roiquant, right? It's a bit similar. We fund people, we fund businesses, and the purpose of the fund is for high ROI purposes, inventory purchasing, ad spend. So the ROI part is very similar concept with Choco Up, and then the quant, right? So we want to leverage on data. So the whole journey is quite seamless, which I can show you. You go into our account, you create an account, you connect your Amazon, eBay, Shopify, all your stores, Lazada, Shopee. You complete your verification, and then we put your data, and then we can do a credit underwriting automatically and give you a credit amount automatically within 2 hours. So the quant side aligns with what Choco Up does as well, because we leverage on data. We want to cut out all the human errors or the time delay by sending paperwork, emails. So as a business owner, you come to our backend, you connect, you create an account, connect to your stores, whether it's Shopify, Amazon, eBay, Lazada, and such, right? And then we can already access your data and give you a credit line. So the whole journey can be very seamless and simplified versus calling someone, emailing someone, getting, sending PDF files, Excel files, your management account, and such. So because we were the end user before, and hence we don't want to go through the same thing. So it's really business owner to business owner, founders to founders. Our target audience, we used to do, we focus mainly on digital business because we can leverage on the data part. And with data, there's less trouble of asking, back and forth. We can shorten the time. However, we do have offline businesses as well, as long as that we can track data. For example, if you're a retail selling fashion, you have 5 shops, offline stores, as long as we can connect to your POS, as long as we can connect to your payment gateway. By the way, we work with Stripe, AirWallex, and other big payment tech companies as well to leverage on the tech to receive all this data, right? And even if you're an offline shop or retail, as long as we can tap in those, we can give you a financing amount fairly quickly compared to traditional means. That being said, we do not try to compete with other lenders or banks. In fact, we work with banks because a lot of these traditional financial institutes, digital business or e-commerce or SaaS platforms or marketplaces are very new. They are asset light. They don't have 20, 30 years of operating history. They don't have stocks or inventory stock that they can use as collateral. So financing all this type of company, new economy, new digital economy businesses will be very hard for traditional FIs. But for us, we become the middle person that fulfill this gap. And we churn out a lot of data. We learn how different businesses behave in different regions and different sectors, and hence banks do like us. So we work very closely with banks, and we work with a lot of other alternative financing options as well, because the pie, the market is so big. As a business, okay, for example, if you need $100,000, taking this $100,000 from a VC, taking this $100,000 from a venture debt, or from a friend, or from a private credit, or from us, has different implication to your business down the road. Hence, you have to choose and pick. So we're not trying to take the market share. No, we want the best for your business. You can use different type of financing at different time. And for Choco Up, for RBF, we can come in anytime. That's how flexible it is. So we are very, very broad versus invoice financing, factoring, vanilla loan, bank loan. Like those are very, very deep, but more silo. But for us, we're more broad. We can be creative in terms of coming up with how to solve your problem. And this is how we fund you. We connect your data, we run it through our own algo, boom, money in your account. And this is half of what we do. The other half is because we're connected to your daily activity, we can help monitor your business health. So we're like a doctor. So, like, hey, how come your landing page per user, the time spent on it is less than the benchmark of the industry? Why is your conversion rate so low? Why is your shopping cart abandonment rate so high? These are the data that we can know immediately. But a lot of this business owner, they don't know. So we tell them, and then we send them to our ecosystem partner to help them to solve this issue in order to help them to improve their sales. So we do two parts: fund you, help you diagnose your business, and help you to grow. So that is Choco Up in a nutshell.
Thank you, Percy, for that introduction. And yeah, I believe most of our audience were not familiar what how revenue-based financing work, but you just gave a very clear explanation. So before we dive into our discussion, I would like to read out a short snippet of a news that was just published recently about the Southeast Asian funding climate, from January until September. This was one that was published by Deal Street Asia. So it reported that venture capital funding actually plummeted with a very steep declines in Q3 this year, making it worse than an already challenging environment, right? Then according to Deal Street Asia, there were only 151 startup deals that actually got signed in the region during July and September this year. So this weakness in Q3 resulted in a 34% year-on-year reduction in total deal volume of January to September 2023, and a total of 52% decrease in total deal value, bringing it below the total amount recorded during the same period in 2020, which was the COVID hit, like the worst year. So this is bad, right? Like how do you view this depressing VC funding climate at the moment?
Okay, my personal take on it, I'm no expert in this field. Just use my own personal experience.
Of course.
As a, to share with you guys. I always feel there's always a lag time. When something bad happened, the result, the aftermath won't happen immediately. There's always a lag time. So during COVID or pre-COVID, things are so good, and COVID hit. So we thought COVID is really bad, but the real implication or the devastating effect probably only start after COVID. So there's a delay, a lag time. This is what I felt. And a lot of people had the wrong sentiment about, hey, after COVID, things are going to get better. But it's not, interest rate is so high. The market sentiment, it's very negative. So it's going to carry on for a little bit until interest rate goes down a little bit. And pre-COVID, everyone is pouring money into everything. As long as you have a deck, you can get money. I think that's not too healthy. It's not bad. It's not good or bad. It's just not too sustainable. And it's finally catching up, irregardless COVID happened or not, in my opinion. So now we're experiencing a phase of market correction, which I believe is good for everybody. We're not living in the dream. We're building your fundamentals, building your business step by step, building something sustainable instead of inflating valuation and trying to hype it up and sell it. In general, that is not sustainable in my opinion. So now is the time where everything is being corrected, and hopefully next year, those that survived and those that hung around and that those are real good business that they can make a lot of positive impact to the rest of the world.
Right.
So that's my take.
Thank you. So we just recently previously ended a VC panel talk, and so obviously the climate right now for a lot of founders, it doesn't do any good that that we're still suffering from the like the repercussion of COVID, and then inflation, like everybody's saying, it's still high, and obviously it's still, and reports have just shown like deals are not being closed at much. So do you then now see this presents an opportunity for alternative financing for founders who are currently generating money, but they may not be hitting the appetite or the benchmarks of the VCs funders? Because in normal times, the VC funders are already hungry, like they need a lot of traction, and the benchmark could be, let's say, you could be growing at 2x or something, right? And then, but right now in particular, in this climate, VCs are tight, in deploying their cash. So they maybe want to look at higher performance. So, maybe last time 2x may not cut it. Maybe they might want 3, 4. So what could alternative financing do at this situation?
No, great question. We work with a lot of different VCs in the region, and Singapore and Indonesia and Hong Kong as well. We definitely do not, fight for portfolio companies. We don't fight with them over. In fact, we work very closely when they need a short-term financing to boost certain revenue or boost certain business.
Like bridge financing.
Bridge financing. We come in very handy. For them. So it's even whether economy is good or economy is bad, I think it's still a very good combination, VC and alternative financing, especially RBF or even venture debts, because we target very different needs of the company. VC is a bit longer term, 5 years, 8 years, or even 10 years. For us, it's about half a year to 1 year. And when time is bad, or when you need to hit to grow boost your bottom line or your top line, the alternative financing option is definitely good. And you don't want to just shut down a business, and it's a lose-lose situation. So for them to come to us, I think that makes sense. And hence we do work with a lot of VCs in the regions on that.
So in your bridge financing, what type of stages do you look at, or are you open? Your stage is agnostic as long as whatever the business it's fundable for, then you obviously have a cap limit, right?
Yeah. We're agnostic in terms of stages, as long as you're post revenue, as long as you have recurring revenue. So if you have run a business, you have recurring revenue for the past 12 months, we're happy to fund you. Of course, the revenue you can't be month on month decreasing at 20-30%. You have to be able to show that your business can sustain. Even if there's no growth, it's fine. That's why we come in to help you to grow. So the number one criteria for us is recurring revenue.
Okay, wonderful. Percy, I'm starting to see a lot of questions. So I'd like to encourage the audience, if you're in the Zoom room, the beauty of the Zoom room here is that you can ask and post question anonymously. We don't need to know who you are, so you don't have to be shy. Whatever you want to ask, just ask. For those of you who are tuning in from our Facebook Live, just leave a comment if you like, and our team will pick that up. Or if you want to ask question anonymously, come and join the Zoom room right now. Now, before I go in and tackle on the first question, because there seems to be a lot, and I want to give our audience time to engage with you more rather than me. I've got one question for you, Percy. I've recently learned about royalty-based funding being deployed in the life sciences industry. Does this work similarly to revenue-based financing?
Yeah. If correct me if I'm wrong,
Mm.
I believe the concept is somewhat similar, except the royalty-based funding, it's a bit longer term.
Yes.
Yes. For us, it's approximately 6 to 12 months.
Mm.
So that's
Right.
the biggest difference. So we don't take equity position, but you pay us back as if we are an equity owner until the principal amount plus our fee is covered.
Right.
That's about it.
So obviously at the moment, Choco Up don't offer royalty-based financing, right? Is
Not
this
yet.
something that you consider down the road to tap into the life sciences industry?
Definitely, when we're very robust in what we do right now, we're always open for idea. The whole point about Choco Up is RBF is a very broad term. It can be a bit of everything. So that royalty financing could be something that we can potentially look into deal by deal on a deal by deal basis.
Right. Wonderful. So with that, I will now switch to the
questions.
tech questions. Yes. So how have businesses successfully integrated alternative financing into their overall financial strategies and capital structure?
Okay. They're depending on your business type. If it's a direct one-to-one Choco Up funding your business, it's a lot easier, and versus if we're integrated into your platform. I'll explain a bit of difference. If you're, let's say, if you're a tech startup, you're just you're a e-com store owner, you have your own brand, you run on Shopify or Amazon. We tap into your data, we integrate into your backend, we draw the data, we can fund you. And then the collection part is also automated. Traditional bank will ask you to pay them 30 days. They send you an invoice, you pay them back, right? It's very manual, very mundane, and not very efficient. But for us, we were integrated into Stripe, AirWallex, all this other payment and wallet companies where every sales you do, we take a little bit back, and you don't have to worry about the whole repayment. And by the time hey, how much do I have left to pay you back? It's already done, and then we can give you a new round of financing. So this is a one-on-one type of integration. Take your data, give you money, we take back through the payment gateway. Also, everything is automatic. This is the simple one. But if your business is a B2B, a SaaS platform, or a marketplace, I'll use a marketplace. If you're a marketplace, we embed in your backend. You have hundreds or thousands of customers on your platform or your business, right? If you're B2B. So we, obviously with your consent, we can do a pre-screening of the data, of the quality of your customers. And each of your customer can get a financing amount from us. Whether you want to call it Choco Up or your platform, let's say your platform is called ABC Capital, sure, white label. We just provide the tech and solution.
Right.
The good point about this, if your customer grow in revenue and size, they'll spend more on your platform. So with this integration, us Choco Up integrating into your platform or your business to help your B2B clients to grow, it's a win-win-win situation. So that is a bit more complex, but we have our product and tech team behind to work on this as well.
Okay, wonderful. So do Choco Up do a partnership with startups such as platform for selling to track the merchant or businesses traction?
Definitely. In fact, a handful of our customers, our clients, they might not use our funding. However, they're still plugged into our system because we can monitor the data. We can help them to analyze what went wrong. And hence, again, like just now when I said, if you're a platform, you have a lot of customers, we can help you analyze your customers' data. The analytic tools that we have, it's real time. So it's another service that I said that earlier on, that hey, we provide funding and we provide a growth solution, and this is the growth solutions that we are providing by integrating into your platform to monitor, to see who's doing well, to see who who needs a bit of help here and there. So that is what we do as well.
Right. So such as we saw, I'm not sure if this person mean is what they've seen, or like if there's a company called we saw. Choco Up integrated with Shopify. Is it other platform also can be integrated?
Yes, we are integrated with Shopify, Amazon, Shopee, Lazada, WooCommerce, Magento, ShopLaza, ShopLine. So for e-commerce, there are two types. One is direct to consumer, D2C, we call it D2C brands, which means you use Shopify, WooCommerce to build your own site to sell. You have your own brand. And the other type is platform seller. You sell on Amazon, eBay, Shopee, Lazada, Tokopedia. So both, we are fully integrated, and we can help you to analyze your data, plus give you the financing amount. Yeah. So it's not just Shopify.
Right. The next question here: what are the emerging trends and innovations in the alternative financing landscape, and how are they impacting businesses' access to capital?
Okay, impacting business access to capital is definitely a plus. There's so many fintechs out there, whether it's a micro loan, whether it's to C, whether it's to B. The speed and accessibility has been improved, every quarter. There is so many interesting way to tap into different source of capital, whether it's equity, whether it's debt, whether it's short term, whether it's midterm, whether it's long term. So the whole innovative thing, it's not trying to take away market shares from the traditional FIs. The FIs will be there forever. The lending landscape, because more and more the younger generation, they prefer to do their own thing. The whole digitalization era has made doing business a lot easier. I use my own experience. Back in 2008, when I tried to build a website, it cost me about $3,000 to $4,000 USD with basic HTML coding, with no plugins and everything. Now you can build one within 30 minutes, using Wix or some other tools, easy, on Shopify, $200 a month. Yeah. So technology has made doing business a lot easier. And when you do business, whether your business is growing, whether your business is going through a tough time, you need money, you need capital, you need extra capital. Organic growth, it's always a bit slower. So with injection of new capital, it's always a plus if you know how to use it carefully.
So is there any industry or verticals that you that could better align with your financing solution?
So for us, as long as we can, obviously e-commerce is our biggest target audience. However, we don't want to restrict ourselves to just e-commerce. Our mission is to help 1 million business owners to grow 10x. And as long as you have digital footprints, as long as you can tap into your digital footprint, whether it's an app, whether it's even if you're a payment company, or even if you are brick and mortar business, but uses certain platform to do sales, as long as we can tap into that digital footprint, we're happy to look at you and to give you a line. Yeah.
And do you cover the whole of Southeast Asia, or are you limited to only a few markets?
Right now we have okay, our journey is a bit interesting. Every startup, every business, you have to go through highs and lows.
Of course.
Our low, we're really expanded too fast. Like we went into 15 different countries within 3 years. And it came back to bite us because we don't have the resource, we don't have the know-how. The whole Southeast Asia is so fragmented. Every country, it will speak a different language. Yeah, consumer behavior is different. Your business appetite is different. We thought we got it, but we didn't. So now we shrink. I wouldn't say shrink. We focus. We found our own focus in Singapore, Malaysia, Hong Kong, and Australia. This four region. This is our main focus for this year and the first half of 2024. Second half of 2024, which we already have began, looking for partners and how to get into new markets such as Indonesia, Thailand, or Vietnam. So eventually, on our roadmap in the next 4 years, we'll love to cover all the major countries in Southeast Asia.
What about the Philippines?
Oh, for sure, Philippines. That's another one.
Right.
Surprisingly, there are a lot of startups in the Philippines, and we have had a few customers in Philippines, and actually one of them went public after we funded them. Yes.
Nice.
But the sample size is too small for us to say, hey, we're gonna work in Philippines, So until we find a dedicated team and have enough data points for businesses in Philippines, we need to be a bit more cautious going in.
Okay, got it. Right, so we've got one last question here. So, by the way, audience, our time is not up yet. So if you've got any more questions, just shoot it our way. But how can businesses effectively evaluate their financing needs and determine the most suitable alternative financing option for their specific situations?
All right, no, great question. I think this is exactly how we differentiate ourselves from other lenders, pure lenders. So having access to our backend self-serve portal to get a certain financing amount, sure, it's great, but it might not be necessary for your business, even if you can have this credit line, let's say $500,000 or so. So we do have a dedicated merchant success team, merchant growth team, that will, more like a business consultant, that, hey, you can reach out to us 24/7. We can look at your business holistically, whether it's online, whether it's offline, whether it's in one city or in multiple cities. So our merchant success and growth team is there to help you to decide whether it's suitable for you. And we believe even if Choco Up is not the right fit for you right now, we can refer you to our ecosystem partners for a better, more suitable lending product to you as well. And we believe one day you will come back to us as well.
Okay. What are the potential risks and considerations associated with Choco Up's financing?
Okay, for us, we are more, I'll say we are more worried than the business itself.
Okay.
The money. We have to raise funds.
Yep, of course.
Yeah, so our approach is not to cannibalize, it's not to be a shark. The fee that we charge is very reasonable. It's a mutual agreement. It's not like take it or leave it. We never do that, because every business in different stages of your journey will have different needs. We can give you the same amount a year ago and today, and it could be different fees, because how you use it, how you apply to it, and the situation of your business at that moment is different. So we look at your business very, very holistically. And a lot of it is really through the data analytic part.
But what never changes is the flexible repayment, right? So if the businesses do well, you'll take within the agreed percentage. If they do low during dry season, dry spells, you would just take back lesser.
Right. And one thing that a lot of people don't notice is, you go to a traditional lender or you borrow some money, there's always a admin fee, drawdown fee, charges, or if you repay early repayment, you have to pay extra For us, we have none of these. It's really just one fee, and you know it before you even enter this agreement.
Mm.
And because we help businesses to grow, if you outperform our projection, we give you a rebate, which
Mm-hmm.
happens quite often as well.
Right. Right.
Yeah.
Okay. So you shared with us earlier about your plans for the next year. I'm curious to know what are Choco Up's next 5 years plan?
Okay. Definitely a lot of internal optimization.
Mm.
Market expansion, definitely.
Mm.
Market expansion doesn't mean remotely, get a co-working space, have a few plants sitting in the
Mm-hmm.
office, and that's
Yep.
it. No.
Yep.
Like market expansion means having meaningful conversations day in and day out,
Mm.
having localization, local team members
Mm.
there to help to build because businesses like the past how many years, business is
Mm.
still a very relationship driven
Mm.
thing.
Mm.
Let's yes, we use tech to enable to help us to be more efficient. But at the end of the day, a lot of it still comes down to uh, the relationship building, the trust,
Mm.
and
Mm.
the presence.
Mm.
So we would like to have more presence in the regions that we're going to expand into. That's number one. And
Mm.
number two is the internal optimization of our tech and product.
Mm.
Right now, the fastest we've come up with financing um, contract to our customers within 2 hours
Mm.
and money in their account within 48 hours.
Right.
One day, obviously depending on the quantum as well, would like
Mm.
to streamline such that, boom, within same day,
Yep.
approved application,
Yep.
approved money in their account.
Mm.
There are some digital banks, neobanks, or as such, they're doing a small amount of financing to
Mm.
businesses
Mm.
within instantaneously.
Mm.
And but those are backed by huge financial
Of
institutes.
course.
We're still a startup,
Mm.
and that is one of our benchmark to be able to do the whole process even more seamlessly.
Right. And of course, in your expansion as a fintech, you also need to consider about regulatory
Regulation. Yes.
compliances, right? You need to apply for licensing and everything. So earlier, that was one of our discussion where we saw, a lot of the fintechs, in this region are probably, going through some difficulties with that. Like, do you find that true for yourself as well?
Oh, no, great question. We have been quite prudent and cautious
Mm.
in this approach.
Mm.
Uh, we'll never be above the law and
Mm.
regulation,
Of
and there's no
course.
point fighting.
Mm.
And hence, we are very very cautious. We have multiple legal counsel that help us in every single country that we work in that we
Mm.
expect to.
Mm.
Um, so we do our homework. We don't want to get burned.
Mm. Of course.
And there are a lot of reg tech companies out there
Mm.
nowadays that makes
Mm.
the whole journey more effective and efficient as well. And
Mm.
the cost is fairly good as well.
Mm.
So
Mm.
so we're leveraging on all those other reg tech and our own resources as well to
Right.
cover this part.
Right. Are you looking in places like Europe, say, where it's
Um,
much easier to navigate, without much of these regulatory issues?
Okay, I'll share a little bit about the landscape. In
Mm.
North America, there's
Mm.
Clear Coal. They're a
Right.
unicorn.
Yep.
So they're the father of or mother of RBF.
Yep.
In Europe, there's Wayflyer. They
Mm.
just raised another $1 billion last year. They're
Mm.
a multi-billion-dollar valuation company helping a
Mm.
lot of e-commerce. In
Mm.
India, there are multiple unicorn club
Mm.
advantage.
Mm.
In China, there's this called MicroConnect,
Mm.
and they're valuated at 1.7 B just this year.
Mm.
However, in Southeast Asia, it's not as there's no
Crowded.
one dominant player
Right.
because the region, the market is so segmented.
Mm.
It really takes boots on the ground to build the business up. And we're very blessed and lucky to have teams from the region to be on the ground building it starting 5 years ago until
Right.
today. So we
Right.
do have a little bit of head start compared
Right.
to the Western counterparts. We
Right.
don't see each other as competitor.
Mm.
It's really industry players that we can work together, with.
And since you also have a base in Hong Kong, so how's the landscape like on the northeast of Asia? Apart excluded China excluded.
China excluded
Mm.
Japan, and Japan's interest rate is so low or negative.
Mm.
It's easier for a Japanese company to get their own
To
funding.
absorb. Yep.
So
Yep.
yeah, in Korea, I mean, the currency fluctuation is just not so favorable.
Mm.
And there are a lot of big Korean VC, so that's a market that we are not going to tap in yet.
Mm.
So, and Southeast Asia has one of the highest population,
Mm.
digital native population in the
Mm.
world.
Sure.
Indonesia alone, like 270 million people,
Mm-hmm.
more than half, they sell stuff on their phone, right?
Yep.
So we would like to focus. We know the region, we know the market, and hence we feel more comfortable. We don't want to go outside our comfort zone yet.
Yep.
Yeah.
Got it. What's the currency of financing for you?
Right now, we have four different currencies: USD, SGD,
Mm.
HKD, AUD. Oh, and ringgit. So five.
Okay.
Yeah.
Ringgit, Malaysian ringgit. Right.
Yeah.
I see. Cool, cool. Um, there's one question here. How do you see the role of alternative financing evolving in the future, and what impact will it have on businesses' growth trajectories?
Mhm. Alternative financing. It depends how much tech
Mm.
and how good their credit underwriting process is.
Mm.
It's easy to give out money,
Mm.
but it's very hard to take it back.
Mm.
So if there are a lot of alternative financing company out there that who are just giving out money freely,
Mm.
it's not good for the market. It's just like the VCs in 2017, 2015 to 2019,
Mm.
the era. So we have to be very prudent as an
Mm.
alternative financing company. I think in general, all of us have to be prudent as well. The return
Mm-hmm.
that we're looking at is very different from what an equity investor, the VCs are looking at. The tenor is much shorter. We don't expect like 10x return. So it's a lot more palatable to businesses
Mm-hmm.
in general.
Okay. Got it. So you mentioned that you're also a startup, like most of us, but obviously you're, more way ahead than most of us, right? So, are you actively also fundraising, like to support this, financing solution for your customers?
Yes, we're fundraising 24/7
Right.
for debt. We have two baskets,
Mm.
equity and debt. The
Right.
equity piece, we're not in an urgent need for that, but if there's a good equity partner who can propel us to the next stage, we're definitely interested. It's
Mm.
more for tech development and cross-border expansion for
Mm.
us. The other basket that we are constantly looking at is debt financing because
Mm.
we need to have wholesale financing. We need to have
Capital to
concentration.
refinance.
Yes, to give it out to, because a lot of this bigger, for example, the financial institute, they write a check of 50 million, 100 million, 200 million to an MNC, easy, they get it back, very safe.
Mm.
But how many businesses out there can get a 50, 10, 50, $20 million loan?
Mm.
For us, we can help this FIs to cut that into 1,000 pieces
Mm.
and to diversify the risk. And we're positioned to do that as well. So
Mm.
we do need to get that debt side to
Mm.
be able to finance all this players in the market as well that the bigger boys don't tap.
Right. So if there are investors or funders, or CVCs or family
Yep.
offices who are keen in your business and would like to join you in your, your journey of growth, is that possible?
Yes, definitely.
And
We're
how
open.
and how can they find you if they want to?
I'll just you have my email, my WhatsApp, my LinkedIn. I'm open. You
Right.
can find me anywhere. I'll reply.
Right. But obviously LinkedIn is easy. Just search for Percy Hung, Choco Up,
Yep.
and then right. Okay.
Yeah.
Wonderful. So Percy, we're running out of time, but I've got a few questions I would like to ask you.
Yep.
Because obviously you're a serial entrepreneur. This is not your first businesses. And obviously, you've been through this, fundraising difficulties. That's why, you're doing what you're doing. So what are some actionable advice that you could give to fresh founders, inexperienced, first-time founders who are now struggling to fundraise, be it equity or whatever, or even they could be, trying to raise RBF from you, but they failed the application. So what are some tips and advice or encouragement that you could give to this young founders?
Fundraising, it's a very tricky thing. You see on TechCrunch, you see on District Asia, you see on all the news, TechScoop, Tech in Asia every day. XXX raised 2 million, 5 million, 10 million. So you get excited. You thought, hey, fundraising, I can do it. But it's a numbers game. We've been through my fundraising list, probably have 200 people on it, or I mean, VC, CVC, debt, credit, private credit, family office, PE. You have to go through. There's no shortcut. Obviously, you have to improve, like review after prepare for the meeting for sure. Do a review, document everything so that you make yourself 1% better for the next investor. Don't let people string you on. Time is the most precious thing for a business owner. So first of all, the hard work. List out. You have to be thick skinned. You have to go out. The first 30 people you talk to, you might get 0 response. Some might string you on, and then the next 30, you have 3. Great, and then the next 30, you have 5. So you improve your chances and odds, and eventually you hit it. There is really no shortcut to that. It's a numbers game. You have to fine tune your approach. You have to study about the investor. What's their mandate? What's their appetite? Like I remember 3 years ago, 4 years ago, when I went in pitching, I was so clueless. I was going to use some explicit word, but no. Yes, I look back like what were I thinking? Got to prepare. You really have to prepare for every single investor meeting, knowing that what they need and want. And if they're not the right fit, move on. It's okay. It's okay. Yeah.
Now, as I understand, there's a sort of like a monthly recurring revenue limit that you have in order for your applicants to successfully acquire the loan from you, right?
Yeah.
And what's the amount?
So right now we fund anything from 10,000 USD to 1 million USD per ticket. Yes.
Okay.
Just now there was someone that asked about the risk, right? I'd like to add on. We are very risk averse, but at the same time we want to help. So we want to find a balance. The risk on us is technically an unsecured loan to the business, but at the same time we're very cautious. We don't give you 1 million upfront. If you're doing 1 million a year, we don't give you 1 million upfront. We give a percentage of your annual revenue to monitor, and that's after the first tranche. Okay, we monitor, handshake, good, then we can increase over time. So we try to mitigate that risk on both parties. On a very, how to say, like we don't try to hit home run right away. First base, second base. That's our approach.
We had a last minute question that just popped in.
I saw that.
What if after getting the financing from you, I suppose, there's little to no revenue within 6 to 12 months due to unavoidable circumstances, let's say another pandemic like COVID happens?
Okay, our first course of action
Mm,
is not to chase you. Our first course of action is to find out why
mm,
and work with you. We have certain data points to show that hey, when the business owner are willing to work with us,
mm,
um, we resolve the problem within a fixed amount of time. But
mm,
sometimes I understand me myself, when your business is not going well, you're not in the right mood to talk to anyone, especially your creditors. So,
mm.
and those
Yeah.
when there's no communication, that's when things don't pan out as well.
Yep.
And because we're liable to our investors as well.
Mm,
So there after okay, first course of of action is definitely to find out what's the problem, and then we
mm,
try to find solutions together.
mm,
We could potentially even restructure certain things.
mm,
But if there's no communication and you know or there's like there's no reaction right on
mm.
both on the other party, so there will be some legal proceeding as well,
Right.
because we're audited
Of
company
course.
by
Yep.
KPMG, and
Of
we have to
course.
be accountable for
Okay.
yeah.
That makes sense. I mean, it's only fair. Um, would you consider businesses that is consistent, that has got consistent uh income of revenue, but has got lower than 10K profit a month?
We can look, and you know what? You could be our next poster child of how to grow from 10K to 50K to 100K.
Mhm.
We love we love success stories.
So just on just try, just
Yes,
apply.
yes,
Right.
yep.
Okay. Now we haven't got any question, but I've got one. Um uh for because you've been on both, I mean, I wouldn't say both sides, like you've raised equity fundraising before, and obviously you're also, like you said, one of your basket of fundraising, it's also to raise debt for you to refinance, right? So you've obviously the math for this two different fundraising, it's very different. So
Yes.
um how would you advise, again, fresh founders in a very early stage, like pre-seed, like most of our audience here right now who are listening, how would you advise them to slowly, um let's say, grow their revenue? What kind of benchmark should they hit and milestone that they should hit, and then to the point that they will reach, first, okay, if your RBF is much easier available for them at the moment until they hit a much higher benchmark for them to, for most of the VC who would even pay attention to look at them. So obviously to get there, they need to get here first, and maybe, and this is where you come in, right? Like you could help them to boost them up. So for them to get to here, what are some of the revenue growth, like benchmarks? And so, and then after that, once they've gotten that financing from you, then they want to grow, let's say, to the next milestone. What are some of the healthy growth benchmarks that you would share?
Um, okay, so just now the questions about hey, recurring revenue, even if it's lower than 10K, we
Mm,
like recurring and consistent because
okay.
consistency it's money.
Right, of course, so it doesn't
Yes.
matter, right?
Yes, it doesn't matter.
Mm,
Hey, 5K US a month, 8K US a month, sure. As you can prove, you can show that. Of course, once we tap in, we can see, right?
mm,
Consistent over 1 year, 2 year, dude, that is good. We
mm,
rather that than 100K, then for 3 months, like 2K.
mm,
Like so. The whole thing, it's about proving that you do have a recurring source of income. I think
right.
that it's key. Well, no
Mm,
matter how big or small, to us, we'll figure that out once we onboard you. Yeah.
okay, so Percy, unfortunately, our time has run out. But before I let you go off, I would like you to share two advice to our audience. One, because like you yourself, you're still fundraising yourself, the pain of fundraising. What kind of like final, words of encouragement that you can give, to first-time fresh founders in their fundraising journey? And second, as a startup founder yourself, what kind of actionable tips, you could again give to these tech startup founders in growing a healthy business?
Um, okay, the first question regarding fundraising,
Mm,
I believe there's really no shortcut.
mm,
You have to put in the hours, you have to go through your list. If you have 50, sure. If you have 60, sure. Keep asking. Don't be shy. Don't be afraid to get rejection. Uh, I got rejected in my face like over 100 times.
mm. You just have to
Uh,
develop a thick skin, right? Like,
yes. And that's okay.
yeah.
Yes, that's why I
Mm.
have, yeah, and that's why I have, yeah, I shaved today for you guys, actually.
Nice.
Very thick. My beard is actually really, really thick. Um, don't give up. It's depressing sometimes when you see,
Mm,
get so much no, and
mm,
sometimes like you thought it's a yes until like after 6 months, a no. That's even worse.
mm,
Gotta learn to just how to sniff out what is real.
mm,
It's easy to
mm,
say, but when
mm,
you're in that zone, you want to be
mm.
hopeful, right?
Yeah, yeah.
So that's the hardest part, in my opinion.
Mm,
But you have to go through the list. You have to. You have to
mm,
build that list. You have to go through one by one, and then revisit one by one.
mhm.
That is key. Okay, so number two, building the business, hiring. Hiring is the most important to build your business. You get the
Sorry,
money,
what's that?
hiring the right
Hiring.
talent.
Right. So focus on hiring.
Talent, yes. You have to hire as a business owner. It's best
Yep,
that you meet every single one that come on board.
that's right.
Just great. The culture fit, the domain knowledge you can learn over time, but the
Mm,
culture fit is so important.
yep.
And don't be cheap to hire because
Mm,
imagine you can have two headcount, $5,000 USD paid per month versus
mm,
one that is 12K.
mm,
That is super good. I'll
mm,
take the 12K. It's it's that could outperform both of them combined all
mm,
day. You know,
mhm,
that is my learning mistake. Like we have done that before. We
mm,
thought, hey, we're
mm,
startup, we should hire lean, be cheap,
mm,
but hey, everyone goes through that journey.
mm,
You have
mm,
to get the right talent,
mm,
um, and trust is
mhm.
so important within your team.
But how do you do so with the lack of resources, like especially funding?
Okay, so initially, that's why you need to have a good, robust revenue generator first. We
Mm,
built our business. We didn't build the tech in the first 2 years. We have zero
okay.
tech. Yeah,
Okay.
we because we know if we build the tech, we'll burn through the roof and will not survive.
Mm,
So we find the lowest hanging fruit. We try to make sales first. So we were a very sales driven company, but the
right.
culture for a sales driven company versus a product driven company is totally different. So
Mm,
and
mm,
now we're definitely a more product driven company.
mm, mm.
Yeah.
All right. Thank you, Percy, for your precious and valuable time and sharing all this information, personal tips, fundraising tips, encouraging words, to our audience. Even myself, I feel, like all pumped up now, it's rubbing off me. And yeah, and most people may not know we're actually one of your strategic partner. So yeah, I mean, of course, our audience can um, approach Percy and Choco Up directly, or you can also talk to any one of our team. We are also here to primarily help our roiquant community to grow. Yeah, with not just equity investments. If you want connection to VC, we can put you to the right VCs that may be aligned with your business growth vision, or if you're looking at alternative and non-dilutive financing such as RBF financing from Percy and his team, we could also help you. In fact, yeah, we've got some perks as well from Percy and his team to offer you. So that's one of the reasons why we're having this partnership. So if you want our perks, like discounted, you know uh fees that Percy will charge you, and come to us, and then yeah,
Yep.
we could work together all together. Um, thank you, Percy, for your time.
Thank you,
Great
Paul.
talking to you, and then we'll catch up again soon.
All right. All right.
Thank
Hey,
you.
you guys are ever in town, you or the audience, if you're in Singapore or Hong Kong, and if I'm around, do drop me a line. Happy to grab a coffee or beer.
Yep,
Yeah.
will do. Will do. Thank
Cool.
you, Percy. Have a good
All right.
one.
Cheers.
Cheers.
Bye.
Bye bye.